So how do we know which institutions are too big to fail? Ever since 2008 and the bailouts of that year, people have been wondering which institutions are likely to receive a rescue in case they're on the brink of failure. The most popular approach to figuring out too big to fail is looking at funding costs. Banks, just like any other commercial enterprise, borrow money from the market. And banks that are perceived as receiving a bailout in case they get into trouble are going to be able to borrow more cheaply than those banks that aren't. The problem with this approach is that there are any number of reasons why a bank may borrow more cheaply than its competitor. For instance, large institutions in all sectors across the economy borrow for more cheaply than their smaller counterparts. In addition, there may be other economic reasons why larger banks may in fact be safer. Their bonds are more liquid, and there's more information known about those institutions, which allow lenders to more confidently lend to them. This doesn't mean that some institutions aren't in fact receiving an implicit subsidy that we could call the too big to fail advantage. But the most popular approach in the research thus far hasn't been able to properly account for all the factors that go into the funding cost for institutions.